Ooh, got it.
What is going on, everybody? Welcome to another Tuesday live episode with your host, Jen and Joe.
Hello, hello.
We've got some really cool stuff. Got a cool guest today. We are going to be talking about conventional financing, creative financing. We're going to answer some questions and talk about how we could team up and make wonderful things happen together. So, yeah, so let's get this thing started.
Yeah, a quick little background is that we were at a local meetup here in Tampa, hosted by Nick, who we actually interviewed last week. So if you haven't had a chance, make sure you check out our YouTube channel and subscribe and check that interview out. And basically, we met some awesome people, and Khaled here is one of them. And oddly enough, we're both all from upstate New York. So little 716-585 in the house. But we have smartened up and moved down to Florida to the sunnier weather. And he is so intrigued by the creative financing options that are out there. And so I thought it'd be really cool to have them ask us some questions. How does it look? What goes on? Conventional versus creative. So if you want to give us a little bit of background about who you are and what you're up to, and then we'll get right into it.
Sure thing. All right. So like you, I came from Western New York, very strictly Western and not upstate New York. Right. So I was in Buffalo, New York, and I had a few rentals up there. And, I got sick of the snow, got sick of the weather, got sick of everything. So I moved on down to Florida about 2.5 years ago. And at the time, I was a high school teacher in the city. And I was also a part-time real estate agent. I was doing pretty well. I was at the point where I could flip and just do that full time. But when I came down here, I decided I wanted to venture into the lending side of things instead, for more opportunity to kind of work where I wanted, not have to see houses as much. So I still stayed in the real estate realm, but I went into mortgages, and kind of person who wants to know everything there is to know about something. I deep dive into subjects, stay up way too late, reading all sorts of stuff. So of course, when I heard about the meetup and I heard your guys' talk, I immediately found you guys in the general room and was like, okay, now I have 100 questions.
Yes, that you did. And so many that I thought, what a great conversation to have with our group here that joins us live every Tuesday. So let's get going.
Yeah, we could share a lot of questions. Some of these questions, maybe some of these folks have not even thought of yet. So that's great to have a professional here.
Well, because we're all taught, conventional is this way, it's black and white, 1 + 1 is 2. And then here we come in with, well, there's a whole playbook of things that could happen. And you just need to know, which play to run essentially for what is happening in every given deal.
Right.
Exactly. So do you want me to
Yeah.
Okay, so well, first I would point out that one of the big differences, or one of the things I always think of, like when you guys started, when you started talking, I immediately had in my head this question, and I was afraid to ask it because I was like, I should know this. I don't want to sound really dumb, but the question was, well, what do you do with their existing mortgage? Because seller finance always tells you they have to own it outright because they're writing a mortgage for you. And I did a similar one before where I had somebody buy my rental, but they paid off the mortgage and I held the difference because now it's free and clear, right? So how would you get rid of the mortgage without paying it off, right? How can they write you a mortgage if they still have a lien? Well, you guys answered that with the whole wraparound mortgage. But my follow-up question would be, when you complete that mortgage that kind of wraps around theirs and allows you to take over it, well, first off, does it trigger the due on sale clause? And I already know the answer to that, but I feel like other people should know this.
So yeah, those are great questions.
Yeah.
Sorry, go ahead. There's more.
There's no
doubt. Yeah, so does it trigger the due on sale? And then also, does it appear on their credit report after that?
So we've got a lot of great questions for some of you folks who may or not know what a wraparound mortgage is. So for an example, we're doing a deal right now in Florida. Somebody just bought their property in March, already moved out, could no longer afford it. She's like, you could just have this property. If you could take over the payments and you cover the closing costs, it is yours. So she owes about $315 on the property. She's totally okay with no money down because she realizes if she lists it with a realtor, it, take out commissions and whatnot. She probably has to owe a lot of money. She's already out of it. So she wants somebody to take over payments right away. So a wraparound mortgage is not me having to give any money. There's no money exchanged. It's a promissory note that's just stating that I'm going to be paying her existing payment. So my wrap mortgage is for what she owes at the same payment, at the same rate, at the same pay down, and her balance. So, and all of wrap mortgages is just a piece of paper that says, I promise to pay these terms to them. So there's no having to go get a loan for that. There's no application at a bank. You're not getting your credit checked to have an attorney or a title company draft up that paperwork. Usually just costs a little bit of money and you have that note. So that's a wraparound mortgage. But the question is, does that trigger what's called the due on sale clause or the acceleration clause, which states in an agreement in most mortgages that if that deed transfers over to somebody else, the lender has the right to call that whole amount due. So does that trigger? It can trigger. So there's a list of things that really put that to the forefront. If you don't make your payments on time, is a big way to trigger that, right? Because now that's sitting on somebody's desk and they're looking at it. Second one is if you don't have the proper insurance. And if you guys don't know how to do that, we did an interview with one of our insurance experts on our podcast. Definitely check it out. Phenomenal way to make sure that your insurance is set up the correct way. So those are the two biggest culprits for having that due on sale clause triggered. We also, not for much of anything, but we also like to deed it into what's called a land trust when we buy the property. So when we deed it into a land trust, the bank is going to see that the property transferred from the seller's name to a trust, which a lot of folks do for estate planning purposes. And usually just for that reason alone, they most of the time are just going to leave it alone. So, and if it does transfer that, or say for worst case scenario, it does, there's things you could do to make sure it's not a problem. You could deed the property back. You could put them as a beneficiary owner on the trust. There's a lot of stuff you can do. So either way, don't let the stuff like, I may get hit by lightning scare you from walking outside. Although people get hit by lightning, but to avoid that. So then the next question was, what happens? Is it still on their credit report? So yes, it is still on their credit report because that loan is still open in their name. So we're working with a seller now who says, what happens if I want to buy a house 10 years from now? Well, they're going to see that on their credit report. It's going to help their credit. An on-time paid mortgage helps your credit. So that account being paid on time for those 10 years is going to keep their score high, as long as they don't go do anything else crazy in the meantime, right? And then what's going to happen is that incoming payment is also going to help wash off some of the debt. So it won't affect their complete DTI. So for an example, if their payment is $1,000 for even number, and I'm paying $1,000, it's going to wipe out about 75% of that. So $750 of that money will come off of that debt. So they'll still show a tiny bit, but it's not going to mess what's called their DTI that much.
So have you found, so you've done this in real world, because I'm thinking how I would exclude it, because that's normally the 75% is, if I have a property that I'm renting, right? And I use the gross rent because I have a lease. So have you had to submit your agreement, your wraparound mortgage to a mortgage company to show them this is how we exclude it?
Yeah, we've done it a bunch of times. We just show them the closing docs. We show that we're the one making the payments. So we
show the actual payments too.
Yeah, we show the payment records that we're making the payments. We show them the closing docs and the note. And we've had this happen a few times to us, and every single time we've had that happen, it's okay, you're all set to go.
Yep.
Sweet. Was it a length of how long were you doing those payments for? I ask because sometimes they want to see it for like a year or something like that.
So every lender is going to be a little different. Some big national lenders may need a year. There might be some local credit unions or banks who might get away with only doing 6 months, depending on portfolio lending and things like that. So every lender is going to be different when you are looking to get their new loan, to see how many payments have to be made in order for them to wipe that out. Most of the time, it's probably going to be 12 payments, but we've had some small credit unions where we did it in, I think, 7 or 8 too. It was a local credit union. And they called, I told them what was happening, sent them the stuff, and they were fine. And that was like 7 months.
Okay. Very
So
cool.
sometimes these small banks and credit unions let you get away with a little bit more. They're a little bit more lenient sometimes than some of the bigger lenders like a Wells Fargo or something like that.
Mr.
Yeah,
Cooper?
usually if you have a brick and mortar, like, a bank, you usually have a lot more red tape, that's for sure.
Yeah, absolutely.
I didn't even bother with that when I was getting my own mortgages. I learned that you go to the small local person or you go to college, rather than going to, a large bank. My first home I tried to buy with Bank of America because I didn't know anything. And that took forever. And in the end, they couldn't do it because I was paying rent to my roommate and he was paying the rent. And they wanted to see my rent receipts, which I've never heard of before. And it ended up not working out. But I got the mortgage from somebody else.
So that was my point. What I was going to bring up is having somebody like you,
Mhm.
because here's the thing, when we started doing really well with our rent to own business, and we had some of our renters now going to be owners, which is really exciting. Some of even the smallest credit unions and banks were having a hard time putting their heads around it.
Yeah.
Until we meet somebody like you, right, who could dive deep into the mortgage lending and, obviously has some things to where you can look at an application and say, okay, this would be a good fit with this lender or things like that. So this is really, I think, been one of the best things for us is finding the right mortgage team to help you with your rent to own business, right? So
I always try to figure out, I look at things from the perspective of what can I do to make this work? Not like, oh, this is a big thing. Come back to me when it's done. I always try to get real creative. Like, okay, well, what can we do to make this work?
yeah,
Even if
absolutely.
it's, jumping some serious hurdles. All right.
Yeah, and
So,
hurdles there will be, let me tell you. So it's important to keep that stamina going, along the way.
I can imagine, whenever you get creative, then it gets
Yeah.
often difficult. So another question I have for you, so let me just cross that one off the list here. Good answer. I am rating you here. All right, so another question I have is you and I were talking about a duplex deal, right? And I know your exit strategy is often rent to own. And one of the questions I had for Joe, and I thought he answered it really well, and I would still love to hear that answer again, was can you do a rent to own for a renter on a duplex?
So that's a great
Multifamily.
question. That you often don't hear, right? Because we do a lot of rent to own, which means somebody's going to rent a single family home from us until they could get through the rent process, right? And they're going to rent it for whatever long it takes them until they're able to qualify for a mortgage. So that's phenomenal. But what happens when there's a duplex, right? Can you rent it on that where there's somebody renting on both sides? So what we found that could be one of the easier ways to do that. Yes, to answer your question, you can do it. There's going to be many people who love the idea of house hacking or things like of that nature. So for somebody who wants to live in a half, be able to manage the whole property, handle all of the things, make sure that the money's coming in every single month to us, the owner, right? But their goal is to buy that property down the road. Because once again, you could do that through an FHA mortgage. Right.
Yeah, I mean, you could do it through
Conventional.
FHA, through conventional, through really almost anything.
So the point is, if somebody wants to be a homeowner and owning that home, and they have a decent amount of skin in the game and things of that nature, for our rent to own program, I would definitely do that.
And when we first started, I would get so many questions because we would just plaster everywhere we had rent to owns available, and that phone would ring all the time. And so many people did ask, do you have any multifamily or any side by sides? Because again, to not have to go to the bank and get traditional financing was really key.
So in the rent to own, normally I know you put a lot of the onus of the responsibility on the renter more than normal long-term rent, right? Because they are essentially taking it over as their house. Do you put the other units' responsibilities on that one person? Like, is it up to them to collect rent?
Yeah.
Oh yeah, that'd be 100% them.
It'd be them to do everything. They're going to basically be like almost like the on-site property manager who's living there, collecting rent, doing the repair, or hiring it out. the same thing that's gonna go.
Okay. What if the other unit doesn't pay rent?
Obviously, that's up to us to then to jump in there on that. But however, technically, we would have it, our lease agreement for the rent to own would be through them. So I would be them in charge of who they're gonna put there. Obviously, I'd want to oversee who they're putting there, probably give it the final okay. Make sure it's not the, neighborhood, whatever. But as long as they check out and they look good to us too, yeah, that'd be fine.
And I would assume, so basically the purchaser's payment that they're paying you would make sense. That would make more sense than simply you just long-terming both of them. Basically, it must take in that risk of them, being in charge of the other side.
Yeah.
Right? Because
And once again, if you're gonna want to live in that situation, you better be getting used to doing that anyways.
Yeah.
The only
Very
difference is, once again, if they don't collect that half and they don't have the extra money, regardless, I'm still gonna make our mortgage payment on time.
Mhm.
And I'm not gonna hold them liable for the other rent, but it's their job to collect it.
Okay, so I guess in a way they would be defaulting on their lease, but it's up to them kind of to bring in that income. It's only hurting them to not get that rent, right? Because they're still responsible for that full amount.
Right.
Mhm.
And we'd give them a discount, obviously, so they'd be getting a good break on that. So it makes it fruitful for them to do this.
Mhm.
Very cool. Yeah, I can imagine, because it's the whole idea of a house hack is that it pays for most of or all your mortgage.
Right.
And I
Right.
think one thing to point out is it's definitely beneficial to do that in Florida versus other states like New York, where the tenant laws are a little, I don't want to say stronger, but trickier in New York. Where down here you have a little more power as the landlord, right? The quicker eviction process.
Yeah, because the eviction process in New York is just, it's
Very
really
drawn out,
difficult.
yeah.
And they're making it harder. So this is why we love, in all honesty, our favorite strategy is single family rent to own method, because a lot of our folks who are going to rent a home from us have some skin in the game. They plan on owning the house, not just renting. So they treat the property a lot different. And our clients, because they're planning on owning it, they treat the property different. They make it home. They really are invested into the property to want to own it at one point. Now, we have one, it just took 6 years.
Mhm.
They moved in 2017 and I just signed the paperwork the other day for it. So it's exciting for them. They've been living there for a long time, but now they finally own it.
Now, what kind of down payment do you take? And it's non-refundable, right?
Yeah, we do. Every house is different. Everybody's budget is a little bit different. As far as what they put down in this situation, they put down a little over 30,000.
Okay.
And that went towards the purchase when they just got to buy it. And they're thrilled because, once again, they had a really large amount of money go towards the purchase of the property. So they're financing less, obviously, less than finance charges they're going to be paying, lower payment. So they love the fact that they haven't had that happen. And now, once again, they own it. Even if rates did jump up a little bit, their payment's still pretty good.
All right. So here's a good question. So those people, it took them 6 years, right?
Yep.
Did their price that they were purchasing at increase at all in those 6 years because the value of the home increased?
Yeah, it did. We kept it to market standards. So we still made sure we weren't going to charge ridiculous amount of money for it, but we looked what were sales that were going on in that area and priced it accordingly.
So in the beginning, so my understanding is the rent to own in the beginning decides the price that they're purchasing it at.
Right. So in the
Right. So-
beginning, what they do is, like, we could give them like a 1-year commitment or a 2-year commitment.
Okay.
And then after that commitment, if they haven't bought it, we could renew the terms again.
As
And
long
then,
as they're paying on time.
yeah, and they take good care of the property and they're paying on time, we could renew those terms, and we make sure, like I said, our renters are still getting a good deal and they're
Mhm.
happy with it. But some of these prices have spiked up, or sometimes they go down a little bit, whatever it
Yeah.
goes. But
Now, if they didn't want to renew, do they get their deposit back?
no, it's a non-refundable
That's what I
option
thought.
deposit. Because the thing is, we really want to sell this house,
Mhm.
and they're holding up the sale, right? They're holding up the whole process of the sale. We're waiting on them at this point. We've got the house market ready. and we're working with that person in order to get it sold. So they're holding up that amount of money over years. So if they've made it through the whole thing and also they don't want the house and they want their money back, they know ahead of time, because we are crystal clear with them what the expectations are in all parties. They know it's a non-refundable option deposit that goes towards the purchase if they're ready to buy. And we've had some who got relocated for their job and they called us and said, hey, we know we don't get it back because our job's moving us to out of state. So you guys are gonna get the house back in 2 months. And we did give them a little bit back, say, hey, you guys are awesome. We loved you. You loved us. We'll give you some money back. Make sure you just keep the house really nice on the way out. And they did. They kept it really nice. We gave them some money back. They were thrilled. We were too. And we ended up putting somebody else in there.
But it's important too, like there was a little wear and tear, being a couple years, family.
Oh,
lived there,
yeah.
Just finished everything in the house. So, it was nice to have had that little bit of non-refundable money to kind of now wait for the next perfect tenant buyer, because we're really particular about who we put in there too. So that's important.
So if they don't purchase by that time that term is over, say it's 2 years, right? Do you have a cap on how much you can raise the purchase price built into the contract, or is it just up to you?
It's up to the market.
Okay. So I guess I'm imagining myself, I'm playing devil's advocate here as the tenant, right? They don't purchase in that 2 year time, right? Date comes, it expires. Can you basically be like, well, now I want $200,000 more? Can you get ridiculous like that? Is that legal for you?
So I don't say it's ridiculous. And the reason why I say that is because in some pockets of the country, that is absolutely ridiculous. And I will come out and say that. However, I live in Tampa. And so let me tell you what happened when we came down here. Somebody would buy a house and then do nothing to the house, a gorgeous turnkey house. They would buy it, do nothing to it. 5 months later, say I want 150,000 more than I just paid for it. I would laugh at them, and then they'd put it on the market and get it 5 months later. And it happened consistently all of the time after time. I laugh, they laugh back. They put it on the market. They laugh last because they got 150 grand, 200 grand over in 1 year. It was insanity down here. So if I had somebody holding up a sale for 2 years here in Florida, in Tampa, and they didn't buy it, and that property value went up to $300,000, that's going to be according. But also too, if it drops a lot, we also hold that too, guys. So if my house was worth 500,000 and I had it sold at 500,000 and a year later the value goes to 450, I just lost a lot of money because my buyer didn't buy.
Yeah. So I
Right.
guess my question is, you say it goes according to market. My thing is, who's deciding the market? Now, obviously, when they go to get that mortgage, it has to
Got to
appraise.
appraise. Yeah, that's the whole point of it. It has to appraise. So you can't be ridiculous. Sure, in any given world, is there somebody trying to sell a $500,000 property for $1 million? But it's not going to appraise. So the lender's got to go through and say, okay, this house is worth 500,000, and I'll lend you based on that value. So you can't be a knucklehead about it.
So, okay, all right, good answers. So, I want to hit you with one more devil's advocate. So, is there any protection for the tenant in you? Because where I was in Western New York, it was like 85% or something like that of rent to owns never purchased, because an abusive landlord would say they had the term, right, 2 years, something like that. It expires. They will just jack the price to the point where they know the tenant can't purchase, so that they can just keep the non-refundable. I guess my question is, what protects the tenant in this situation other than, what would?
So as far as the tenant goes, make sure you stick to your end of the bargain. If you got 2 years to buy it out and you need to get your credit fixed, fix your credit in those 2 years and don't while out in those 2 years in the meantime. Now, I understand, don't get me wrong, there are plenty of good people that had just had something bad happen to them. So I get that, but like, don't go wild knowing that you're going to try to buy a house, do all of the things so you could fix your credit. I've got one of my buddies, he charges like $100 a month. He tells me within 6 to 9 months, I could get somebody's credit turned right around. So if that's the case, and I could get somebody's credit turned right around that quick for $900, then go spend $900 and get that, right? And that could save you tens and tens of thousands on finance charges. So this is where we really look at that. Super important. So how to protect the renter, do the right thing on your half, make sure, number two, what I see a lot of times is somebody says that I'll sell you this house. It's a $200,000 house, $300,000 home, $500,000 home, and they'll want like $4,000 down.
Mhm.
Let me tell you, when you're ready to get a mortgage, you're going to need more than $4,000 down to buy a house. So a lot of times what these folks do is they don't collect enough money. So now John and Mary go and fix their credit, and they do all the right things, right? The lender says, okay, John and Mary, you're ready now. It's been that 9 months, 12 months. You're ready to go. You just need $32,000. John and Mary look at each other, say, well, we're supposed to get the other 28 because we give 4 to the landlord, right? They're not collecting enough money. So you need to make sure that the folks you're working with have money set aside, have an action plan in place to get their credit or whatever's holding them back, and then help them with the process. Just like anything else, if you just kind of, throw a book at some people and say, go learn this, they're not going to do too well. But if you help people and you actually hold their hand through the process, and some people work a little faster, some people are a little slower, but if you hold their hand through the process, we actually have a very high success rate. We still have some folks who are originally in the house like these folks in 2017, still in these houses, and they're now just buying it, but we don't throw them out.
I think too, like it's back to like the landlord, like what kind of person are you, right? And our philosophy is people over profits. We're not greedy or constantly, educating ourselves all of the time. So it's just really important too to make sure everyone does their due diligence and know exactly like who you're working with on both sides. Great question here that just popped in. Do we run our rent to own by our tenants through a third party RMLO process?
So we don't. We kind of do. What we do is we use what's called screenthetenant.com. Screenthetenant.com charges $50 per applicant. I know when you do an RMLO, it's usually about 1,000-ish. So with doing screenthetenant.com, because they're still renting, when you look at the interview we did with Paul and his team, they're based in Pittsburgh. He's an investor himself. He actually looks like what it's like to get him qualified in a handful of different mortgages. So he gives you a snapshot on income, on their debt, credit reports, background checks. I mean, we get everything. It's like 70-page report basically. And it's going to give you a time frame of, I think these people are going to be mortgage ready in 6 to 12 months or 12 to 18 months or 18 to 24 months, as long as they do X and don't do X. And I recommend them for credit repair, or they're fine without needing that. And they give you this great report. So when we have somebody who wants to rent on one of our properties, we send them that link. That's their application. And then we get that application back in a couple of days. And then we have that conversation.
Thanks. I was going to ask you to share that link from when we talked, which was Screen the Tenant.
Yep.
How do you think increasing interest rates will impact tenant ability to buy in the incoming months?
Let me answer this one. So essentially, your buying power over the last, let's say, year, because it's August, was when we saw the interest rates start to really rise up. July, I guess, so we're almost at a year. So your buying power has actually gone down in terms of strictly your purchasing power with interest rates. However, as we are seeing inflation kind of stagnating, coming down, we most likely are peaking at inflation right now. The Fed is talking about not raising or only doing one more rate hike in the next meeting. And so most likely we're going to see interest rates start to come down. So your buying power, I would say, instead of saying it's going to get worse in the next few months, I'm going to say it's going to get better. But as those interest rates come down, everybody else is going to see that too, and they're all going to want to start purchasing as well. So you're going to see much more competition. So actually, if you were a tenant and you were doing a rent to own and you locked in this price for a year with the current market, right? Say you lock in $100,000, right? Nice and where if you find a house for $100,000 around here, say you lock that in. If interest rates continue to come down through the end of this year, that home would actually be worth more because more and more people are going to start, like the demand is going to be higher. So it's actually going to be really beneficial if you can lock in any sort of home price right now for a year, that's very beneficial because as rates come down, values go up. That's where you see back when we were talking about people flipping houses without even moving in, doing anything. They buy a house in Seminole Heights because interest rates were 3% and everybody was out there looking, and they just sit on it for 6 months, sell it for 100 grand more.
Right.
Wholesalers were doing that right off the market.
Well, and that's where I would see a lot of times, everywhere around the country, I think the interest rates are going to make a difference and an impact, because like where we are in Florida, a 1,500 square foot ranch could be 5, 6, 700,000, depending on where you are, sometimes more or less. But then there's some pockets of the country that same ranch might be 125,000. So if interest rates went up 2 points on that $120,000 home, that really doesn't make a bigger impact. The ones that are going to take the challenge, you try to buy an $8 million home, right? But if you're buying an $8 million home, you could probably swing the difference in the payment. I'm just going to say that. But that's where you might
Plus
see
a couple more points there.
Right. But that's where you're going to obviously see, a greater impact. So I will tell you, for what we love, rent to own, where I think the market is always going to do well, is going to be the median and slightly under that. Somebody who is a young newlyweds looking to get their first home, or just anybody looking to get their first home, or they're looking to downsize from maybe their big home into something a little bit smaller. Those houses in that median to slightly under, I think, will always stay hot. So if you're in the lesser expensive realm and rates start to vary up or down a little bit, if you find a great house in a great neighborhood and it's an affordable thing, rates, I don't think we're going to make that much of a difference. Now, they go to 8, 9, 10%, and just the fear factor. And some of the folks in this room were around in the 80s when rates were, in the teens. And that was a normal thing. Although houses were $15,000, $20,000, $30,000, it's all relevant, but that's the difference, right? So I think as rates where they're going to stay now, 6, 7%, maybe it gets a little bit more in 7s, maybe it goes in the 6s. But, if you're trying to buy a $10 million home, it might hurt a little more. But if you're trying to buy the normal stuff, you'll be fine. Cool. Great questions today, gang.
Yeah. We'll see if we'll take another question or two. I'm curious about those that are near the end of the agreements. Well, like we said, we've got literally one right now. We just signed the paperwork last week, so I'm not sure the exact rate they're getting locked into, but.
So yeah, we've got one. They are literally buying it right now. I just put the FedEx stocks back into the UPS store originally until they told me, what are you doing in the UPS store with a FedEx? So I walked out of there looking like something else. But either way, when I dropped those back off, they just qualified for a mortgage. So maybe the rate is 6%, I can imagine. But if I have renters who are at their end of their, say, 2-year, we have a bunch right now that we're all sending out renewals saying, hey, the new price is this, the new rent is this, sign below. And keep, enjoying your house. So the one thing about having rent own, which we do love, is that, in that 2-year span, what's up, like, yeah, on paper, and it's only on paper, but, we get an increase in our net worth because those prices went up. Rent went up on a bunch of those properties too. So, you'll see an increase in income there too, but obviously so did taxes and insurance. I will tell you, this whole price market being thriving lately has had new assessments on values. And depending on where you are, some of these places are a little bit more aggressive with their assessments. We're from upstate New York, so taxes are high. And I know the taxes have increased, so have insurance. So, you just have to price it accordingly. And that's why we don't want to tie yourself into a super, super long term. We did one, I will tell you, a mistake on rent to own. Anybody want to hear a good mistake?
Of course.
We locked in a renter at a 5-year rent to own agreement, guys. The rent stays the same, and so the price for 5 years. Don't do that. Okay. Do a 1 or 2 year and then revisit the figures after that. Because at the end of 5 years, which is next spring, if he doesn't buy it, there's going to be an adjustment, obviously. But you don't want to see that price increase a ton. And he still has the ability to buy it. I don't know if he's going to.
Plus, if you're in Florida, a lot of insurers pulled out and canceled their renewals come June, August. So if you had houses that you were, the cash flow made sense at a certain price, we saw 60% statewide average in insurance increases
Mhm.
over the last year. So that also would have really hurt.
Right. Oh, yeah, for sure. Now, this house, don't get me wrong, it's in upstate New York. It was like a $70,000 home that had like some 3% interest rate, payments super low, and we're making fine on the rent, but still it did change, right?
Mhm.
Yeah.
So we'll be okay. So cool. Well, I am so happy we had you on today. You had some
Yeah.
really great questions, but of course you would have. That was expected. So we knew you were going to come with the goodness today, and it was delivered. So
I
Awesome.
do have
So,
one more
yeah,
if we
all
got
right,
time.
the
Yeah.
final one, and then we gotta go pick
All
up
right,
kiddos.
final one. So you take a down payment for your rent to own, right? Non-refundable down
I know.
payment. You said that goes into their purchase price.
Hmm.
Now, does that simply just come off the top? Like your purchase price is 300, now instead it's 270? Or are you giving them that as a credit towards closing costs, down payment, etc.? Which is
shows
true because that's limited.
yeah, it shows right on the HUD statement. So I just got one on the one we're talking about, and it shows the price was, X. It shows what all the fees are and all the other stuff involved. And then it shows their money down. Just a line item on the HUD statement. And it's going to show us like they gave us cash down.
Okay, good. So that was my question. Are you holding that like a down payment? Because that's the most beneficial, because one of those divvy, those other things, they do it that you're helping them save up for a down payment. So in this way, like those people, they only collected $4,000 and they didn't save anything extra. So if the 30 just came off the purchase price, then it would make less sense.
Yeah, so it actually gets held for them. It's not really held. It's our money to spend. Our accountant counts as an income, so you're able to spend it right away. However, we do keep a copy of the front and back of the check to send that to the mortgage folks to show that we've received it. And then that usually makes them happy. And so once again, line item on the HUD statement, it breaks down how much money we owed on the property. And then it shows us our juicy check that we get. And I'm like, high five. Because it's now we're gonna go buy a bunch more houses this way.
Awesome.
No tears over losing a door.
Well, that's why everybody's like, you're gonna lose a door with rent to own, and they get so like upset about it. And I'm like, yeah, but if you buy the way we do, I might lose one door that I'm making $400 a month on that I collected $30,000 years ago. But I could go buy 4 more doors with that, 4 more single family homes, if not more,
And
with that
it feels
back end check.
so good to help people own a house. Like you must feel that too, like when somebody is like, they're already in it for a while, which is cool, but now it's theirs, right? Like there's just such a cool feeling, especially like when they get teary-eyed because they didn't think they were going to be able to ever own a house, but now they've been in it and they're like, wow, like this really happened and we were able to help them along the way. And it's just a really cool process. Again, when you do business right with the right people, it's truly rewarding. The money is awesome, but that feeling was really cool. I'm
And it
excited.
is. So as much as it's losing a door, I'm excited for these.
Yeah.
folks, 'cause- and this is one of my favorite houses. It really, really is.
I know, it's so cute.
It is. It was one of our special houses that we both loved. And I'm happy it's theirs now. I really am. I couldn't be happy for him.
Yep. So
Awesome.
thank you so much for coming on today. Go ahead and
You're
catch the
welcome.
replay if you hopped on later, then check us out, YouTube, Creative Finance Playbook. And if someone wanted to reach out to you here in Florida, how can they find you?
The best way to find me is if you're on Instagram at College Closes Loans. If you want to call me or text me anytime, I work late and I work weekends. That's 813-470-0634, 813-470-0634, or guildmortgage.com/Khalid Murad.
Wow.
Awesome.
And
Thank
what
you.
states do you work in? So everybody knows that they call you. They're not gonna be like, I have a house in like Canada.
Arkansas.
Like, where are you? Yeah.
I work in Florida, all of Florida, but I do have connections elsewhere. And if you need anything real estate related, I used to be very well connected in Buffalo, and I still most of those people. Know most of those people.
So my Florida peeps, if you need some help, you know where to go.
Absolutely.
Even if you're not ready to apply, you just want to like ask a question, I'm still here for that.
They're gonna be calling you.
Yeah. Let's go
Let's go.
Buffalo. All right.
Go Bills.
Take care, everybody. We'll see you next week.
See you guys.
Bye.